The last thing we're going to add is how asset purchases can actually change around your working capital. Now, the definition that we have of working capital from way back earlier in the term is it's the difference between current assets and current liabilities. In the context we're working in here, working capital basically means the changes in the amount of inventory you have to keep on hand and changes in the amount of accounts receivable that you have. So that we're dealing with those two parts which are current assets. The idea that we're working with here is that because we have purchased this asset, for whatever reasons, we expect to see changes in inventory or the amount of accounts receivable. The idea is that when we specified what was different from the base case, when we bought this asset, we said, well, look, in 2010, we're going to have this $1,000 increase in sales. And we also said that this vehicle, for whatever reason, was also going to have some smaller operating expenses. Now, those two things combined together meant that more than likely, since you had extra sales, the size of the accounts receivable that you had out there was going to be larger by a little bit. And so instead of having only, say, $2,000 worth of accounts receivable, you'd have something like $2,150 worth of accounts receivable that are commonly floating around out there. So what we're doing here is saying that because you purchased this vehicle, inventory requirements are a little bit larger, accounts receivables a little bit larger, and so there's actually going to be, what we're seeing here with this negative $200 is there's a reduction in the amount of cash that you have available. Okay, so working capital ends up sucking up some of your cash because it's all bound up in that little increase in inventory you have to have in order to make those additional sales, and some of your cash is going to be tied up in that accounts receivable, effectively lent out to other people. Now, the other thing that we specified in this problem was that that $1,000 boost in sales was only going to happen in 2010. And in 2011, that burst of sales was going to go down. And so what we did here is we said, well, look, that burst of sales wasn't a permanent increase in sales. And so while in 1 year we needed to have more inventory hanging around and we were going to have more accounts receivable, in the next year we're not. So that cash that was tied up in those two areas was going to be released back to us as cash. So what we're seeing here in this cell for working capital in 2011 is this release of working capital. Now, it's important to see what goes on in the year 2012 because we're seeing there is that the amount of working capital that we have, which again you should think of it as inventory and accounts receivable, is at the same level as it would be in the absence of purchasing this new car that we had here. So it's back to the regular level. So the idea is, again, in 2010, we have $200 more than we would have in the contrary case of purchasing this vehicle tied up in inventory and accounts receivable. In 2011, what we're doing is releasing that amount and having this extra cash available. And then in 2012, what we are seeing is that we're at that level that we had before, that there's no additional change.